Whereas the Nifty and the Sensex are flat, though marginally in the green. The mid-caps as well, just 0.03%, so really flat. But Bank Nifty up there, 0.5% higher. And therefore, I have with me someone who watches banks very closely, Anil Agarwal, the banking analyst at Morgan Stanley. Anil, thank you very much for finding time from the conference and from your clients to speak with us.
No, thanks.
First let me start with the news that just came in overnight. The Reserve Bank giving more teeth, as it were, to banks to seize promoters' assets if they don't obey restructured milestones. Do you think this is a major positive? The market seems to think so.
No, I think it's a very big positive because hopefully it will deter the promoters from not following the restructuring norms which have been laid down as a part of the restructuring exercise. So I think it should be a big positive. Obviously, we need to wait and see the execution of this. So obviously, the proof is in the pudding. We need to wait for that. But fundamentally, I think this is a great concept. This should deter the promoters.
Okay. Would this make you believe that the NPL cycle at least will peak off now?
So I'm not very sure whether this is going to reduce the
NPL
formation dramatically.
I mean, a mix of possibly a recovering economy, which your economist seems to believe, plus moves like these. Would you say that we have already seen or will see this quarter the peak of NPL cycle? So
my view is that the peak of bad loan formation cycle, Lata, was F15. So if you look at last 3 years, on an average, in all the 3 years, banks had about $40 billion of new bad loan formation, that is NPLs and restructured loans combined. I won't be surprised if this year that number is at least $10 to $15 billion lower than the $40 billion number. So from a bad loan formation perspective, the numbers should be significantly lower this year. Obviously, composition will be very different because there won't be any more restructurings. It would all be NPLs. The other thing is that while bad loan formation will reduce, the provisioning cost on the P&L will still remain very high for, I think, for the next couple of years, because the provisioning coverage ratios that banks are running with is very low. So you need to make provision on the earlier NPLs. But new bad loan formation will be significantly lower than last year. That's our view.
I do hope you're right, because that itself will be a very big positive for those who are already holding banking stocks, or those who want to jump into it, because ultimately a recovering economy has to be played best through financials. Okay, so how would you play the financials? What would be your favorites? I'm given to understand you will not be stock specific in your comment, but to the extent you can advise our viewers, what will be the stocks you will prefer?
So our view is that we would just own the private banks in India. They're the best ways to play the recovering economy. As you said, the best way to play a recovering economy is the banking sector. And what's happening within the banking sector is that there's a complete dichotomy in terms of fundamentals right now, because state-owned banks are very short of capital. So the result of which they are unable to get out of the NPL cycle that they are in right now. On the other hand, the private banks, so we had a note out yesterday where we spoke about how the market share in the banking sector is moving to private banks. Everybody looks at the balance sheet share shift. So from a balance sheet perspective, private banks are gaining share at the pace of about 1 to 1.5% a year. But if I look at the profit market share, in the last 3 or 4 years, private banks have gained 20 percentage point of market share in system profit. So they make 17% of system in terms of balance sheet, but they are now 40% of system profits. So I think while economic loan growth in the system will be, say, 13 or 14% over the next couple of years, the economy is picking up but at a slow pace. I think private banks will grow at 22, 23% on average, which is by far the fastest growing loan growth in the world, not just in India. So I think people will chase the private banks. Within private banks, you can decide the stock you want to own. There are some retail banks which are higher multiples. There are some others which are more corporate oriented, so you can own them. Our view is just own a basket of private banks.
Wouldn't there be a valuation argument for public sector banks? At least a couple of them are better than the others.
Yes. No, some of them are better than the others, but then that's reflected in the multiples also. So you have the better ones which are trading close to book. The ones which have a weaker balance sheet are close to 0.4 times book. So market is very smart, right? So market is already differentiating the stocks. The question is whether the stocks will be able to meet cost of equity on a sustainable basis. So to pay a premium on book, you need to have stocks delivering returns which are higher than cost of equity. And that, I think, will be very difficult for the PSU banks, even if they are capitalized, because structurally they make about 0.8, 0.7% ROA if you look at last 20 years. Leverage under Basel III is going to come down. So it's going to be very, very difficult, even in good times, for these banks to deliver 13, 14% ROE on a sustainable basis. So if that's the case, then going above book is very difficult.
Okay. Well, actually, over the past 3 or 4 months, we have seen the biggest private sector bank underperform the market. would you say the bank Nifty from here on, or okay, your basket of private sector banks will outperform the market, or will they do as well as the market?
So we have an attractive view on the sector, which basically means that we are saying that we would own the banking sector overall index over the market. Okay. So we think that the banks will outperform despite the weakness in the state-owned banks. Our view is that the banks will outperform the overall market. Okay.
Jonathan was telling us that a 10 to 15% return on equity is possible from a 12-month angle. For your basket, you would expect a better return.
So again, it's a dichotomy, right? Okay. So the state-owned banks will have single-digit to 10%, while on the private bank side, depending on the banks we are talking about, there will be one bank which is around 15, and most of the others would be about 18 to 22% ROE.
Would you be positive about the non-bank finance companies as well?
So non-bank finance companies, I mean, the positive for them that is happening right now, Lata, is that they are obviously funded wholesale, and wholesale funding cost is coming down quite materially. At the same time, lending rates will take time to come down simply because of the way the base rates mechanism is structured. The result of which the margins for these NBFCs are opening up. Now, there are a couple of NBFCs which are seeing asset quality issues, but I think over the next 12 months, they should stop seeing those asset quality issues. So we have bias on most of the NBFCs, barring a couple of them.
Okay, well, since you touched on base rates and margins, what kind of base rate falls or deposit cost falls are you seeing in private sector banks, in the banking sector, over, say, 12 months?
So from a deposit rate perspective, so right now if you look at it, one-year deposit rate, State Bank of India's one-year deposit rate is about 8.5% roughly. Inflation, whatever is the number, say 5 to 5.5%. So you have real deposit rate upwards of 300 basis points. That's just massive. I don't think that makes sense. So unless inflation goes up dramatically from here, I would think that you should have at least 100 odd basis point cut in deposit rates over the next 12 months. And I think that's the real cost of capital. In the past, while there's been changes in repo rates, banks have not moved deposit rates, and that has not changed the cost of capital for the overall economy. I think deposit rates will come down by 1% at least from here, which will reduce the cost of capital, barring inflation shooting up from here.
Okay. No, even if we go by the Reserve Bank's view, it would only be 6%. Yeah. So you're still talking about a very big real return.
Historically, average real return, real deposit rates in India have been about 1 to 1.5%. And right now, you talk to any bank in India, the thing they're not worried about is liquidity. I mean, liquidity is it's a fairly liquid banking system right now. So why do you have to offer 300 basis points of real deposit rate?
No, only when they go whining to the Reserve Bank governor before any credit policy, there is absolutely no liquidity. Afterwards, the liquidity somehow comes. But I take your point. I mean, we were speaking to Mr. Aditya Puri just recently, and his view also was that, a good 75 basis point cut in base rates looks very likely, or at least in deposits looks very likely. But what does this do to margins? Will they be better because the rates are falling? Usually Indian bank margins improve when in a rising rate cycle.
Because of the CASA structure, right? Because CASA deposit rates are sort of fixed. So when rates are coming down, that should impact margins, not materially, but you will have, again, depending on the bank, you'll have 15, 20, 25 basis point margin compression on the basis of 100 basis point of rate cut. But a 100 basis point rate cut will be fantastic for the bank stocks, because what it does is that it takes up volume expectations, it takes up fee growth expectations, it reduces the asset quality issues, and most importantly, it reduces the cost of equity, which is embedded. So while margins will be down, I think the P&L will be unaffected, and it impacts the PE multiples in a positive way.
Okay. One final question. I mean, I'm trying to get some kind of color from your advice, because you won't talk stocks. Would you prefer those stocks which are unaffected by this FII limit holding, and therefore are also affected by their presence in the MSCI index? Will you prefer those that are not affected by these caps?
No, I would see, my view is that, so my view, I would buy the private banks even if they are affected by the MSCI gaps, simply because ultimately the stock price, I mean, obviously indexes matter in the near term, but from a structural perspective, if a stock is delivering 20 to 25% earnings growth, I think it will reflect in the stock price, whether it is in the MSCI or not, doesn't matter. So I won't differentiate. Getting added to the MSCI can be a catalyst in the near term, but from a fundamental perspective, I don't think it will affect stock price performance dramatically.
Okay, you didn't say this, but obviously one can read at least one stock which is there in your basket. Thank you very much, Anil Agarwal, for joining us with your views.